The following is paid programming.
It's time to talk taxes.
New friends, new opportunities, new partners. EG Tax.
It's Ask the Tax Lady with Esther Gulius and EG Tax on News Radio 930 WBEN. To reach Esther now, call 803-0930. Toll free at 1-800-616-9236. And cell calls are free at star 930. And now, live from the WBEN studios, it's Esther Gulius.
Hey, everybody, this is the Tax Lady, and this is our hour to talk taxes. And I mean, I can't think of a better time. It's tax season. And I got Chris. Chris Fabian. I drug him out of the offices. Hey, Chris, how you doing?
Good, Esther. How about? Oh, wait. Hello, Esther.
Hello, Christopher. It's nice to be out in the sun.
It is. It is. The sun is, it might be a little bit chilly, but it's sunny out, and that always puts everybody in a better mood.
If it snows a foot, with the ground being thawed, I thought it would melt, and thank God it is. Okay, let's talk taxes. 8030930. Enough.
No weather.
No weather. This is not the Weather Channel. 8030930. 8030930. Star 930 on a cell phone, and we want to help you with your taxes. We do have a subject matter today, but you don't have to stay on the subject matter. But we were going to talk about why it's very important that you pay attention to capital assets. And a lot of people will say, oh, and I got to pay capital gains. Is that a bad thing, Chris?
No. Capital gains is a good thing. You get the preferred tax rate, which is, for some people it means you pay nothing.
That's exactly right. I mean, when people say, oh, and I got to pay tax, they don't realize that the truth is not on the state of New York, but on the federal government. When you have a sale of a capital asset, you may pay zero in capital gains. But in order to do that, do you just put it in and use the tax chart to do that, or do you have to do a special thing?
No, there's a special worksheet on the Schedule D for capital gains, and that also includes your qualifying dividends gets taxed at the qualified
at the lower rate.
Yep.
So when you have capital assets, that's not a bad thing. That's a good thing. As a matter of fact, if you were able to reclassify something that you sold, you'd want to sell it as a capital asset. Like, for instance, if you're selling stock and you're going to make $1 million gain, let's say a $200,000 gain, and you could keep it for one extra day, so it became a capital gain because you held it for more than a year. That would make sense, wouldn't it?
Yep, because then you're paying, for 2017, it's 15%, and I would assume it would drop to 12% for 2018.
That's what it sounds like. And so it's so unbelievable that people don't know what to do, and so they end up shooting themselves in the foot. Like, for instance, I've talked to people that don't know how to read their brokerage statement. Your brokerage statement is very, very important. It lists interest, it lists dividends, it lists sales of stock. And if you don't dig into that brokerage statement, you can miss something, and as a result, you'll owe taxes later on.
Right.
IRS
I mean, also,
you a bill.
You may, I invested in this tax-free investment. Well, okay, that's all the way over that says tax-free interest, exempt interest, but you got to look at it to make sure it's New York because otherwise you're going to have to add it back to New York, and New York will catch it about a year and a half, 2 years.
So when you're looking at that brokerage statement and they say that you have exempt interest, it is exempt on the federal, but if it's not a New York State bond that they invested in or one of the municipalities in New York State, they make you add it back in.
Right, and I believe it's the Rochester one through Oppenheimer. Isn't all Rochester, New York? It's
just called Rochester.
It's just called Rochester, so you got to be really careful.
Right, that's right. I'm Esther Gulius, the tax lady from EG Tax, 8030930. 8030930, star 930 on your cell phone. All of our offices are open 9 to 5 tonight, 9 to 9 Monday through Friday. If you have any tax questions, you can go to our website at egtax.com. Ask the tax lady. I will get back to you right away. Those of you that email us know that I get back to you right away. And we want to help you with your taxes. And if you're sitting there and you're perplexed about capital gains, what is a basis? Why is a basis important? We want to help you. Right, Chris?
With whatever tax questions you have, we want to help you.
Let's go to the phones. We're going to talk to Kevin first. Hi, Kev. How can we help you, sir?
Hi, thanks for taking my call.
Yeah, what can we help you with?
Question for you on 2018 AMT tax. I'm trying to figure out my withholding.
You mean 17?
No, actually for 2018.
Going forward.
All right.
Taxes, yeah, I'm trying to do a projection for 2018.
Okay.
And next year I'm going to end up itemizing, not itemizing, rather. I'm going to be taking my standard deduction.
Right. Mm-hmm.
So I'm assuming that means that there's not going to be
Any AMT. Right.
right?
Right.
Oh, okay. Yeah, I just
Unless you had
Perfect.
some type of accelerated benefit on a stock, you wouldn't have any AMT.
Okay, great. That's what I thought. I just wanted to make sure. Thank you.
All right. Thanks, Kev. Bye-bye. I'm Esther Golias, the tax lady from EG Tax, 8030930, 8030930, star 930 on your cell phone. Yes.
Yeah, I was going to say, and that's what we're trying to help people plan for next year. But I'm telling people, we know what they said. We know what, came out. But until they dot their I's and cross their T's and they actually come up with the forms and the instructions, we're basing everything on what they said.
That's true.
You got to, pay attention and.
Yeah, and if I can kind of build on that. So I'll give you an example. At the end of the year, they said, this is the tax change. This is the way it's going to be. These are permanent tax changes. Then they went into the budget reconciliation thing so that we wouldn't run out of money. And they came up with like 100 tax changes, which are retroactive to January. And it's true they're supposed to be expiring, but we really don't know. So until the regs come out, that's one thing EG Tax will
Right, and then I guess when they just signed the regulation for taxing people bringing goods into their country, he then changed some more tax laws. I think it was more sales tax and different things like that. But this is, whenever they pass something, could always be something on the back end.
Some little rock there could be. But I will tell you, and those of you, like for instance, over-the-road truckers that have lost the ability, or outside salespeople, you lost the ability to expense some of your over-the-road expenses. Well, not some of them, all of them. Make sure you talk to your congressperson because they seem to be in the mood to reinstate some of these tax law changes. Let's go back to the phones, and we're going to talk to Chris. Hi, Chris.
Oh, how you doing, Esther?
Good.
I got a question for you. You kind of opened the show with what I was thinking, and I was going to.
I know, Chris. You and I are on the same line.
Mind melding.
Yes.
I did my taxes last Sunday with one of the box programs.
Yeah.
And basically, I'd taken some capital gains, which something I had to do for my kids' college, and I thought I was going to get whaled on the federal. And I'm looking at the math. I'm actually getting a refund on the federal.
And you got whaled on the state.
Rand, but I got whaled on the state.
Right.
But that would be correct. We don't have a lot of income, my wife and I.
So here's the thing: you probably paid 0% on the federal. But on the state of New York, they don't have any kind of preferential treatment of capital gains, and so you would have paid at the regular tax rate. So it probably is correct. But let me ask you this: is your income under under 40,000?
Our earned income between the two of us is under 40,000.
So do you have children?
We have two children. One is still deductible. The other one is 18, so we don't get any kind of child deduction rate.
That's not true. A child under
You
the
don't
age
get
of 19.
I mean, we get the exemption, but we don't get like the.
Okay, and you got the earned income credit, and you claim both of the kids on the earned income credit, right?
Well, we couldn't do that because of the capital gains.
Oh, it's over 3,000.
Well, you don't know what it all depends what the gain was.
Yep.
Just because the stock was sold doesn't mean that. So you had income over that one threshold. That all was your stock. It didn't belong to somebody else, did it?
No. It was mine, and I put it in the joint account when we got married.
Okay. All right. Good enough. So, okay, but yes, you're right. You would have gotten whaled on the state.
Yeah, and that's okay. So it just didn't. I was, like I said, I thought I have to really write a big one for the Fed too. But yeah, the state was. I don't want to say shocking because obviously we're in New York State.
I know. Now, something you might want to look at is you might want to look at putting money into an IRA. You might be able to reduce your tax liability on the state and the federal through that too.
Right. If I put as much as I can in the IRAs for my wife and I, because again we're semi-retired, so we're above that too.
Right.
Put the 6,500 in.
Right, 6,500. Right.
Significantly reduce the state.
Significantly reduces state and federal.
Right. Well, I'd actually get more refund. Yeah.
Right. Yep. Absolutely.
I ran the numbers, and I want to say if I put 7,000 in, it would have a swing of almost $1,000.
That's right, and it would increase the earned income credit.
Right. But again, we don't qualify that because
Oh, that's right, because of the what is that called?
3,000 or whatever.
Unearned income.
Yeah.
Yeah.
But it's called disqualified income.
Disqualified,
right? Yeah. So anyways, well, thanks for calling.
And I know he said the unearned income, but that just kind of gores my bull because you know what? I worked hard to save that.
Okay, but this is why they call it disqualified income, because they take a look at this for the earned income credit and they say if you really have that kind of unearned income, then maybe you don't need a handout from the federal government.
Oh no, I understand that. So I get my point is instead of buying say cigarettes and Malt 45, I saved 50.
Well, and that's great. You're a great example, but
We were budgeting to save.
That's great.
This was dividend reinvestment programs for my wife and myself.
Yep.
Since we were married young in our 20s.
And you're sure if it was a dividend reinvestment program that you added all the basis to make sure that that your gain was taken into consideration properly?
Definitely was, and the gain's still high because a lot of this I bought back in the 80s.
Okay.
And
all right.
Before we had kids and that. So
thank you, sir.
Just didn't look right, Esther, but you're saying it's fine. So
it is, yeah.
Okay.
Thanks, Chris. Bye-bye. I'm Esther Golias, the tax lady from EG Tax, 8030930, 8030930, star 930 in a cell phone. All of our offices are open tonight till 5. We have 3 mall offices tomorrow.
Yep, 11 to 5. We have the McKinley Mall out in Blaisdell. We have the Boulevard Mall here in Amherst. And we have the Fashion Outlet in Niagara Falls.
And those will be open tomorrow. The rest of our offices will be open 9 to 9, Monday through Friday. And if you need us, you can go to our website at egtax.com. We're going to take a short break, and we'll be back on the other side with your questions. Hey, this is Esther Golias, the tax lady, and we're talking taxes. We were talking about capital gains. That last caller, though, Chris and I were talking while we were waiting for the break to be over about this is what's so important about tax planning. If this lovely guy that just called had income of about $34,000 with children, earned income, he would have qualified for an earned income credit of about with state and federal about $4,000. So you want to make sure if you're somebody that has that kind of situation where you'd have children that are in your home, you have earned income, and you qualify for the earned income credit, that you would plan in advance because you would never want to lose $4,000 in tax.
No, and it could have been just like I believe he might have said his capital gain was $4,000. That he could have sold half in 17 and half in 18.
Right.
And that would have then gave him so.
Or if he would even put it in a margin account, if he would have borrowed against it. If he needed the money, he could have, like if it was something important where he needed the money, he could have borrowed against a margin account and then sold it again in January to pay off the margin account.
Right. And that's what we say all the time. Before you do anything, give us a call.
Yeah, you don't have to be our client. We will still help you.
Yep.
Right?
Yep.
And we're not going to say, and how come you don't use us? We just want to help you.
That's right.
Because you can't say much bad about us at a dinner party if we're helping people, right?
That's right.
All right, let's go back to the phones, and we're going to talk to Raj in Grand Island. Hi, Roger. How can we help you, sir?
Yes, I got a real simple question.
Yeah?
My computer broke, and I can't print out the forms that I need to fill out my taxes. Where can I get paper forms in?
Really, Roger, it's tough. I mean, you're going to do it on paper?
Yeah, I've always done it that way.
Wow.
I mean, you can try.
I don't know where you'd get. Without being able to print it off your computer. I don't know.
Yeah, because I think both governments, the federal and New York State, stopped giving them to libraries and post offices. So
I'm sorry, Raj. I don't know. Really.
Okay.
Sorry, sir. Thank you. I really don't know.
Yeah.
I mean, they don't want you to do it. We get a fine if we file people non-electronically. Oh, let's go to Terry in Buffalo. Hi, Terry.
Hey, Esther. Hey, just to I seen some paper forms at in front of Amherst Library just a few days ago.
Did you?
Yeah.
All right. There's for our last call.
For Roger, Amherst Library.
What can we help you with, Terry?
Hey, well, thanks for the topic. I have a question on capital gain.
Yeah.
I bought an investment property for $100,000 and I did some work to do it for improvements of 50,000, sell it for 200,000. You know that do I pay? Is it first of all? Do I pay that 12% capital gain on the rest of the 50,000, or it doesn't make more sense to do to claim to work that on a Schedule C?
Well, no.
Right,
well, are you flipping the property?
Yes.
Are you a flipper, or is this just an investment?
No, well, this is my first one, so, you know.
All right. So if this is an investment, then it would go to the Schedule D. Is this your only source of income, or do you have another source of income?
I do have other sources of income.
All right. So if it's, I mean, obviously you would not want it to be a Schedule C unless you were really in the business of flipping
Yeah,
property.
if you're doing one and that's all you're going to do, you know, then it would be a Schedule D. But if you're doing more than one, then it becomes a business. And
but we have to quantify more than one over an 8-year period.
Right, right.
You know, I mean, in other words, if you are consistently buying and selling property on an ongoing basis, so it looks like that is your business, then that goes on a Schedule C, and you'd have to pay FICA, and you can reduce it by your expenses. But if you are an investor, and that comes to intent, then it would be a long-term capital gain if you held it for more than a year. I would say in your situation, Terry, you want to make sure you hold it for more than a year so you'd have the long-term capital gain as opposed to ordinary income.
But then you can only have one property for 8 years, right?
No. I just was as an example.
Okay.
In other words, let's say that you say this year you're doing a flip, maybe next year you're going to do a flip, but maybe you won't do a flip again. If it's going to be a business, if you're going to be in the flipping business where you buy and sell, then it's self-employment. Only you can say what your intent is going to be.
Okay, got it. Thank you very much.
Okay, all right, thank you. And that's, it comes down to intent.
Yep.
Right? Okay, let's go back to somebody in Buffalo, and I don't have their name. Hi, this is Esther. How can I help you?
Hi, this is Josie.
Hi, Jose. What can we help you with?
I have a question for you. I have a Roth IRA. I took out $3,000 last year, and I understand it's not taxable.
Maybe. How old are you?
I just turned 59 in December.
Then
did you take it out before you turned? Well, you're not 59 and a half.
So Josie, it is taxable. Part of it is taxable. The basis that you put in to the Roth is not taxable, but the appreciation is, and you're going to be penalized for taking it out before 59 and a half or holding it for
5 years.
5 years.
Oh, I've had it for a really long time.
Right, but you still have to be over 59 and a half.
I thought with the Roth you didn't have to pay.
Well, your thought wrong.
Because
you thought wrong.
Oh, I thought that's what a Roth was.
No, you thought wrong.
Yeah,
Believe it or not, there's rules with the Roth. The Roth is tax-free. Well, first of all, I think many people that are in Roth shouldn't be in Roth, but that's my editorial. But it has to be, the money comes in after tax. The appreciation is not taxable, provided you did not take it out until after age 59 and a half and you held it for 5 years. Otherwise, the appreciation is taxable and can be subject to penalty.
Okay, so it can be subject to penalty.
Yep.
And this year, I'm going to be 59 and a half. So when I go and take it out...
Then it would be tax-free.
Everything.
Yep.
Wait till you turn 59 and a half.
Yes, I will. Well, it's too late, but...
It's too late, baby. Now it's too late. Okay?
I was doing it on the computer, and it kept taxing it, and I'm like, why?
Yep,
because
you got
the computer is very smart.
Yep, you got to do the 8606, page 2.
Yep.
Okay, I understand. Thank you very much.
You're welcome, sweetie. Bye-bye. I'm Esther Golias, the tax lady from EG Tax, 8030930, 8030930, star 930 on your cell phone. I think we can sneak George in. Hi, George.
Hello. I'm calling about rental property and taking repair or depreciation on some things that were done.
Okay.
A hot water tank, is that considered a repair, or does that have to be depreciated?
That is a capital improvement. So that would be depreciable. But the thing is, with the safe harbor election, if it was under $2,500, you can write the full thing off.
Right, but you have to make the safe harbor election.
Okay, what's the safe harbor election?
That's when you get in the boat and
and sink with it.
Yeah, no, that you have to put a form on.
You have to a handwritten letter
that says I'm making a safe harbor election to expense this equipment because it's under $2,500.
Well, it was $900, and then a bathtub, resurfacing on a bathtub, that was $1,450.
The same thing. Normally, that's a capital improvement.
Right.
So you would have to depreciate it,
but
you
one
could
thing about the safe harbor election, you have to make it on every
item individually.
Right.
All right. Then just like a new toilet for $235, is that?
That's another one that'll qualify for the safe harbor election.
Oh my gosh, we got about 6 forms then.
Yeah, but what you can do is make a blanket statement that says, under the Internal Revenue Service rules, I'm making an election to expense under safe harbor.
Okay. All right, you got time for another question?
Yeah.
I'm 70 and a half.
Oh, actually, wait. You know what? I think we have to break for the news. Can you hang on until after the news?
Oh, sure.
All right, good enough. I'm going to put you on hold, and I'll see you on the other side. And I'm Esther Gullius, the tax lady from EG Tax. We're going to break for news. We'll see you on the other side.
There's something wrong here, there can be no denying.
Boy, that's Carole King singing It's Too Late, Baby. It is too late. And some of you that made some of your decisions, it's too late. Once you make that decision, It's too late. That's why we're a really great resource. We really would love to help you at egtax.com. So you can go there and ask a question. Call us on the phone. We have real people there to help you. And let's see, we're going to go back to
George.
Who was it? Was it George? Okay, George, you're back on, sir.
Okay, before we finish, the safe harbor, you just list everything on a piece of paper and you're taking the election? That's all you have
Yep.
to do?
Yep.
Put invoice numbers down or anything, or where you got it from? Or?
No.
You should list what assets you're making the election for.
But you don't have to attach the receipts or anything.
Right.
And then just attach it to the Schedule C? Schedule E, rather?
E,
yep.
Right. Mm-hmm.
Okay, on distributions for IRAs, I'm 70 and a half. You have to take any percentage or just whatever you want to do or what?
It would be nice if it was whatever you want to do, but there's a divisory table you have to go by. When you're 70 and a half, you take your balance at the beginning of the year and divide it by 27.4, and that will give you your first year's distribution.
Can you take it out just one for all of them, or does it have to come out of each individual one?
No, you can add your IRAs together and come up with a total, and then divide it by 27.4.
Oh.
And the first year, George,
yes.
You can actually fend off and not do the distribution for your RMD as long as you do it before April the 1st of the next year, and you do a second distribution that same year.
All right, so I'm 70 and a half this month, March.
Okay.
I can wait till March of next year to do.
Yeah.
Then I got to do 2 of them.
Right.
Yep. So depending on your income for both years.
Right.
Okay. But you can't put another. You can't put another IRA. You got to.
No, you got to take it out.
You got to take
it's
it out.
A required minimum distribution.
But you can put another mutual fund that's not in it.
You can put it into an investment if you don't need it, but you can't put it in another IRA.
No. All right.
Okay, George.
Okay. Thank you very much.
Thank you, sir. I hope we helped Mr. George. Let's
Yep.
go back to the phone, and we're going to talk to John in Tonawanda. Hi, John.
Hi. Listen.
Yeah.
Got a form 8949 from the broker.
Mm-hmm.
Schedule the part 1 and part 2, 8 through F.
Uh-huh.
What does it mean? The short term
is an A or a B.
Schedule
okay.
B
mm-hmm.
is not reported to the IRS.
Well, they're not reporting the basis to the IRS, but believe me, they're reporting the sales.
They're reporting the sale.
Right. So what they do is, under the current law, the broker is required to keep track of your cost basis to make sure that your gain or loss is reported correctly. But if it was something that maybe was transferred in before they started using it, they don't know what the basis is. So they may put down what they think the basis is, but they don't know for sure. And so that's when they would say that the basis is not being reported to the IRS, because you might have bought that, maybe that stock was inherited and you have a stepped up basis. They really don't know.
Yeah, well, that's the case that I've had, that the basis would be somewhere in 60s or 70s, and it would be not reported, so it could be any number then.
Well, it would be what it really is. I mean, so they're reporting what they think, okay? But they really don't know. Like, for instance, maybe let's say you transferred an ABC stock that you inherited from your father, and it was worth $50,000 at the date of his death. So that's your basis. And since then, you bought more ABC stock for $10,000. So your real basis is $60,000. But all they know is the 10. So and let's say it got sold for $70,000. So they would say a $70,000 sale with a cost basis of 10, because that's all they know. But you know better.
Yeah. Another quick question. I got mutual funds. The net proceeds or qualified gains were something way up high. And is that really reported even though the sale wasn't made?
Yep, because that's capital gains the mutual fund made itself. Not you buying and selling, but the mutual fund itself buying and selling its shares. So yes, that you do have to report that on your Schedule D. If you don't, the IRS will send you a bill later on.
Well, that could mean also the very next day the mutual fund could go down and you're double loss.
Yep, but you still have to pay tax on the gain.
Right.
Okay.
Okay, John?
Yep. Thank you.
All right, thank you, sir. That happens all the time, by the way.
What was it, 2008, I believe, when the market crashed? We had a lot of people coming in. How do I have capital gains? I lost $30,000. Because you have to pay tax on the gains, and you don't get to claim the losses till you physically sell
the stock.
Yep.
Right. So, and that's what happens when you have mutual funds and they're throwing capital gains. You have to report that. A lot of people will say, but I never took any money out of it. Doesn't make any difference. If you're reinvesting the stock, that's how your basis is going up. Yep. So that's things that you want to take advantage of. I'm Esther Gulias, the tax lady from EG Tax, 803-0930. 803-0930, star 930 on a cell phone. I know we got David's waited along, but I wanted to talk about this. That's what's really important. In capital gains, it isn't like what you paid for it necessarily is your cost basis, is it, Chris?
No.
Because it might be, you could have acquired these capital assets a myriad of ways. You might have inherited, you might have had it gifted, you might have bought it. Right? You might have made it.
Yep. Reinvested dividends, payroll, buying it through payroll, through each paycheck. You know, there's so many different things in so many ways. You got to know it all, and don't just, And
well, the bottom line is, if you just take what the broker gave, you're going to overpay.
Right. And
if
you're the type of person who goes from broker A to broker B to broker C, make sure you carry your basis over. You tell your new broker, because otherwise, if you don't,
you're going to overpay.
You're going to overpay.
That's right. All right, let's go back to the phones, and we're going to talk to Dave. Hi, Dave.
Hi, thank you. I just point of information and a quick question. The Buffalo and Erie County Public Library has an amazing set of services, including, I'm sure, for that gentleman who called, printing any form he wants.
All right, that's a good suggestion.
Very good. It costs you 10 cents a page, maybe 15, but it's
good.
It's a great service. The other thing is why, and Chris, why this new standard deduction is so generous, but take away the personal exemptions? I don't understand.
It's not so generous, Dave. The person who wrote this, I don't know who they were, but they were really brilliant because they have eliminated the personal exemption. They've doubled the standard deduction. So most people, I would say, they say 30% itemized now. I'm sure it'll go down to about 20%. The interesting thing is then people's taxable income, I don't know if you noticed, Chris, it's going to go higher. The tax rate percentage has gone down. But if they want to raise a flock of money, all they have to do is raise the rate by 1%, and boom, it's going to happen. So they did that. I don't know why. Obviously, as an income, as a way to raise some income, because pretty soon, if they're short money, raise the rates by 2%, 1%, and everybody's going to pay a whole lot more money.
Yep.
Well, thank you for explaining, because I was thinking I was crazy, but
no.
I just
no.
had a
You're
couple
using
today
your brain.
They have 4 kids, mom and dad, so they have 6 exemptions. They were writing off $26,000, not next year.
All right. Okay. Well, thank you.
All right. Thanks, Dave. I'm Esther Golias, the tax lady from EG Tax, 8030930. 8030930, star 930 on a cell phone. So let's talk about, a lot of people wonder about, let's say mom's got a house and she wants to gift it to you.
Mm-hmm.
And so she gifts it to you, and she goes into a nursing home. Let's say 5 years, it's 5-year look back. She gives it to you 10 years before she goes into a nursing home, and she bought the house for $20,000 and it's worth $200,000. What would your basis be if you sold it?
$20,000 plus any improvements, but basically, if there was no improvements, you have a $180,000 gain.
Now, if mom was in a life estate, if mom said, "I want a life estate on this house," and then mom did a life estate, then went into the nursing home, then upon her death you inherit the house, what would the basis be?
As long as mom passed away, then you get the stepped up basis of $200,000. So then you sell it for $200,000 and you pay no tax.
So that's really, really important. These kind of planning situations are so important because, you mean well. Obviously, mom would have meant well that she gave it to her kid. She would think that would be the thing that you should do. But unfortunately, from a tax standpoint, it's not so hot.
No.
I mean, even if you had a $180,000 gain, even with the preferential tax treatment, you would pay, probably state of New York and everything, you'd pay about $50,000.
Right. We have Jeff Katz is a great advertiser for us, and he's a wonderful elder care lawyer, and I'm going to say, if you talk to him, but then call us and say, what if I do this, what is this going to mean to me if something happens?
That's exactly right. Okay, let's go back to the phones. 8030930, 8030930, star 930 on a cell phone. If you're wondering what to do with an asset, what happens if you inherit it? I just had a lady today that said, my aunt passed, and I've inherited a lot of things. So what's going to be taxable? And I said, was it cash? And she said it was a lot of cash. That's tax-free. Was it a house that you inherited? She said, I did inherit that. I said, you inherited it? It didn't go out, it wasn't gifted? Yes. I said, then it's going to be tax-free. Did you inherit any IRAs or annuities? Yes, that'll be taxable. Right? So It's very important that you do planning. Let's go back to the phones. We'll go to Mike in North Tonawanda. Hi, Mike.
Hello, Chris. You did my taxes yesterday, and you did a great job.
Thank you, Mike.
But my question is for Esther. You just made a comment on the radio that certain people should not be in Roth IRAs. What did you mean by that?
What I meant by that is that let's say right now that you're in the 25% bracket, all right? And so let's say that you would put $6,000 in a traditional IRA. So that means that you would save in federal taxes $1,500 and maybe another $500 in New York State. So right now you would save $2,000 putting money into a traditional IRA. That traditional IRA is going to grow tax deferred, but when you take it out, it is taxable. Under the present tax law, if you're married filing a joint return, you won't pay taxes because you're over the age of 65, husband and wife, till you get to over $27,000 in taxable income. So if the only source of pension plan is your own traditional IRA that you've been funding, or 401k that you've been funding, let's say you have $300,000 that you've been funding in your traditional IRAs. Based upon your life expectancy, you probably might only be taking out $10,000 a year. Would you have $200,000, $2 million at $300,000? Okay, but anyway, so you would be taking out $10,000. You would never pay any taxes on that money, so you'd lose the benefit up front, and you'd lose the benefit in the back end. And there would be, and the benefit in the back end would be you wouldn't pay taxes. So what you're doing is you're losing the front end benefit in exchange for something on the back end that you don't even need.
Right, and you got to look at what tax bracket you're going to be in, and I know your situation, Mike, and your Roth is a good place for you.
Right. I mean, there's some people, Mike, that have New York State pensions, and they're going to get $80,000 in a New York State pension or a federal pension. That's different. But many people, probably most people, are funding their own retirement. And even if they work really hard, they're only going to have $300,000 or $400,000. If they take that out, annuitizing it, they're only going to take out $5,000 to $10,000 a year. They'll never pay taxes on the back end, and they've given up the benefit on the front end.
Okay.
Got it?
Yep.
Thank you, sir.
Okay, thank you.
Bye-bye.
Yeah, no, I mean, I know his situation, and I can't get into it over the radio, but he is fine. But I know I had someone earlier this week who was putting in, they're at the 25% bracket, and they were told to start doing a Roth. And I said, why? Because my broker said so. I said, well, so you want to pay 25% now to avoid paying 12% later. And they just gave me this look like I was on drugs, and like, why would someone tell me to do this then? I said, well, you got to understand taxes. And
I was illustrating here, somebody putting in $6,000 over a 30-year period, they would have given up $60,000 in tax benefits, which means they overpaid their taxes because they put it into a Roth so that they wouldn't pay taxes on the back end, which they're not going to pay anyway. And that's where planning is so important, where you have to really sit down and say, what is your goals? What do you think you're going to end up with? And if you're in something that's completely self-funded, it is difficult to save money.
Right. And, speaking of too late now, baby, they used to have the old law going into 2018 was if you put money into a Roth, if you can move from a traditional to a Roth, and after you got your taxes done, you can convert it back.
Do a reclassification.
To the traditional and avoid paying the tax. Now you can't do that anymore. So before you do anything, for people who are listening, I know this is like the fourth time we said this, give us a call.
Yeah, and so the thing is, you could reclassify before April the 15th. Now, once it's in that Roth, it's in the Roth. You can't reclassify.
So if you move $50,000 at 25%, you just spent $12,500.
I just had a client before we came who has a traditional IRA, and their broker said, "Okay, well now that you're going to start withdrawing, what we should do is move you from a traditional IRA to a Roth." So they have $300,000 in their traditional IRA, and they're going to move. They were talking about moving it into a Roth. It never occurred to them that they got to pay $75,000 in taxes in the year that they do that.
Yep.
And they said, "What?" And I said, "Yes, it becomes fully taxable if you're going to move it from a traditional to a Roth." So think about things. It's it requires some thoughtful planning.
Yep.
Right.
Definitely.
I'm Esther Golias, the tax lady from EG Tax, 8030930. 8030930, star 930 on a cell phone. Getting back to capital assets, if you're in a brokerage account that is for your IRA, that doesn't have to be reported now unless you're taking money out of the IRA.
Right.
Because a lot of people bring in those brokerage statements and think that they have to report it. You do not report money on an IRA until you do the distribution, and that's reported on a 1099-R.
Right. Right.
Okay? And speaking of that, if you have a 1099-R, the first $20,000 that you receive in your pension or annuity is completely tax-free once you hit the age of 59 and a half.
Correct.
And if you're in a federal, state, or local pension, no matter what your age is, it's all tax-free on New York State.
Yep.
Okay? All right, let's go back to the phones. We're going to talk to Mr. Bob. Hi, Bob. How can we help you, sir?
Hello. I heard you say about the Roth IRA, which I've been in for a while.
Yeah.
Because I have a small pension, and the box is checked, so I had to do an IRA.
Right.
I mean a Roth.
You didn't have to do a Roth.
Well, depending on his income.
I couldn't add.
Oh, you're saying that the box was checked not on your W-2, but you couldn't contribute because you made too much money.
Well, it got checked one year, and I put all this money in, and then I couldn't deduct it. So that's yet another 6,000 something.
All right. So okay. All right. Then we'll talk. So you're doing an 8606.
That's it. Right.
Okay.
For 1 year.
Okay.
The question about the Roth, I heard you say that you have to have been in it for 5 years or 59 and a half. I'm already 63, but I'm looking at my late 60s, say I retire, but I've been putting money in all this time. And let's use an example. I'm 68, and then I decide, okay, I want to start collecting. But the year that I turned 68, I was still putting money in, so it hasn't been in there for 5 years. In fact, 4.5 years worth of money.
It goes by the original start date.
Okay. Oh, then I'm safe.
Okay.
Yeah, I've been in.
Saved by the bell, Bob.
Okay, and then does that mean I could take as much out as I want, or is it?
Yeah, you can. I mean, one thing about a Roth is once you're in the Roth, you can take it out, and you meet that 5-year requirement, age 59 and a half. Then you can take out what you'd like.
Okay, and I might just, if things go well, just leave it if I don't need it and do the RMD because I got other things going. I'm half self-employed and half real employed, so.
Okay.
Sides of the coin going. So.
Well, you realize when you're self-employed, you can put money into an SEP as well.
I used to have the SEP, yes. But then there's also a matter of making enough money to have enough left over to do that.
You're exactly right. I mean, I can spend people's money pretty good, but but by the same token, you got to live your life, right?
And then I had too many things going, so at one point I combined, and I now, anyhow.
Well, anyway,
yeah.
We'll talk later, Bob. Thanks for calling.
Okay.
All right, thanks. I'm going to go to Jeremy and Clarence. Hi, Jeremy. How can we help you?
Hey, I have a question. I fall into that state employment, and I do have a traditional IRA as well as a deferred comp, a separate deferred comp. Am I wasting my time?
All right, so here's the question. Do you anticipate that what your pension will be? You sound like a young guy. What your pension will be when you finally retire?
State system for 5 years. I put 9% of my paycheck into a deferred comp, and I also have that state pension. And then every week I put 50 into.
But you have no idea what your pension will be when you retire, Jeremy?
It's going to be like around $4,000 from the state.
A month.
Right, roughly.
So let's say really by the time you retire, it's more like 50,000. So what you have to balance is how much your tax liability would be based upon your filing status and everything, and what the tax laws will be. One thing I will tell you is it all depends on what happens with Trump, whether Trump gets reelected or not, and what the Democrats are going to do. And that requires some crystal balling. But I would tell you, you would be definitely a candidate for a Roth.
Okay, so should I transfer the traditional?
No, don't transfer. Leave what's in there, and just maybe make fresh contributions to a Roth.
Oh, okay. So rather than doing the 50 every
right, because you don't want to have to pay $20,000 in taxes, for instance, to move from a traditional to a Roth. Just let it grow tax deferred.
I get into with
right
getting my taxes done, and I
and
then I heard that, so I was like, oh, this is the perfect time to call you guys. And,
good.
Yeah.
All right. Thanks, Jerry. Bye-bye. I'm Esther Golias, the tax lady from EG Tax. We hope you give us a try this week. Our offices are open 9 to 9, Monday through Friday, 9 to 5 on Saturday. Until next week, I'm Esther Golias and Christopher Fabian and Jerry and Heather. Call us at the office. We'll talk to you later. Bye-bye.